Did you know that there is a central bank for central banks? It's called the Bank for International Settlements, or BIS, and it's safe to say it has a front row seat to what's really going on in the global financial system. Recently, the BIS published its annual report about the global economy, and the reaction it's got from mainstream media outlets suggests that it's about to see a big change, and not for the better. That's why today we're going to summarise this report and tell you what its findings could mean for you and for the markets. This is a video you cannot miss. The report we'll be summarising today is aptly titled, quote, Annual Economic Report. It does what it says on the tin. It was published by the BIS late last month, and we'll leave a link to the full report in the description. Just be warned, though, that it's a big one, 150 pages long. As such, we will only include the juiciest details for the sake of time and our collective sanity. Now, the report begins with a brief introduction that's also aptly titled, quote, So far, so good. In other words, the economy isn't that bad, given that there's been a global pandemic, 2 major geopolitical conflicts, and growing political instability. But, as the authors stress, challenges remain, and that is an understatement. The authors go on to give a brief overview of various macro factors and note that monetary policy has been successful in taming inflation. This is significant as it suggests that central banks will begin lowering interest rates even though inflation is still above their 2% targets. Some of them have already started. The authors also tip their hat to fiscal policy, aka government spending, which has basically been keeping the global economy afloat. To put things into perspective, many governments have been spending more than they did during recessions or even during wars, despite the global economy reportedly being just fine. Makes you think. Now, the authors then cautiously declare that the banking crisis in March last year was a one-off, despite reports that many banks are sitting on enormous unrealised losses. If you've been keeping up with our macro coverage, you'll know that many small banks are also struggling because of commercial real estate. Obviously, the authors acknowledge that the monetary policy of central banks has started to diverge, with some central banks like the ECB cutting, some central banks like the Fed keeping rates where they are, and some central banks like the BOJ starting to raise interest rates for the first time in decades. That third bit is significant, as many investors have been taking advantage of Japan's low interest rates to borrow Japanese yen and use it to buy other assets. If the BOJ starts raising interest rates in a meaningful way, this could cause the so-called yen carry trade to unwind, causing global market volatility. The caveat is that the Fed's restrictive stance has caused the yen to keep falling against the USD. The authors seem to suggest that this could continue and that the Fed would work with the BOJ to make sure that the yen doesn't completely collapse by doing things like forex swaps, i.e. giving the BOJ USD. The authors then pivot to examining the predictions of market participants. As you might have noticed, most investors are expecting a soft landing. That is, inflation will come down without unemployment going up or the economy slowing too much. The authors seem to imply that this prediction is premature. From the BIS's perspective, the biggest risk to a soft landing is the unfathomable amount of debt that's been taken on by the private sector, aka households and corporations, and the public sector, aka governments. The authors note that these debts have put limits on fiscal and monetary policy tools. The BIS also sees inflation as a risk, specifically inflation coming from a rising cost of goods caused by supply chain issues, and inflation coming from a rising cost of labour due to a shortage of labour. Not to brag, but this is exactly what we predicted will happen in our video about why globalism is dead. And of course, the authors acknowledge that a spike in commodity prices related to geopolitics could also cause a resurgence in inflation. And they say this, quote, The outcome, so far, has been surprisingly benign, but tougher tests may lie ahead. Translation: geopolitics could become more volatile. For what it's worth, the BIS believes the banking system will be fine as there's more money sloshing around in it than before. The catch is there could be issues in the non-banking sector that spill over into the banking sector. I'll quickly note that there are quadrillions of dollars of derivatives debts. Next, the BIS fumes about the fact that fiscal policy is interfering with monetary policy. In plain English, governments keep printing while central banks are trying to stop the printing. The authors also highlight the fact that a boom in productivity would be a solution to debt problems, but productivity is slowing. And finally, the BIS reveals that central banks will raise interest rates again if inflation doesn't come down, and that we could be in for years of central banks aggressively raising and lowering interest rates to keep inflation under control. The authors also touch on the role of AI, but we'll come back to that later. And if you're enjoying the video so far, be sure to hammer that like button to let us know, and subscribe to the channel and ping that notification bell so you don't miss the next one.
Glenn Hoddle, your incredible season continues. Congratulations on another man of the match display.
Yeah, thanks, yeah.
There's been speculation that you've been using the Coin Bureau deals page for the first time this season. Is that what's put you 9 points clear at the top of the league with only a few games left to play?
Yeah, look, we're a great team. We go out there and fight for each other every single time, but yeah, the Coin Bureau deals page has definitely made a massive difference, to be fair. Yeah.
Is it the 70% discounts on trading fees that have helped the most, or the sign-up bonuses of up to $100,000 on some of the best crypto exchanges?
Well, yeah, both of those have been great, but also as the discounts on hardware wallets too, they've definitely helped us tighten up at the back and become stronger defensively. Yeah.
Well, you played a blinder today. Will you be celebrating with a spot of crypto trading tonight?
Yeah, sure, yeah. That and a couple of Instagram girls, Yeah.
Okay, introduction out of the way, the first part of the report is about monetary policy. For context, monetary policy is important because it involves adjusting interest rates, and interest rates affect how much people can borrow. Because the economy is debt-based, less borrowing means less economic growth, and vice versa. The authors start by reiterating that everyone expects a soft landing. That's essentially because interest rates were able to rise without restricting borrowing too much. The authors repeat that fiscal policy has helped with this, but this time warn that governments need to restrict spending to bring inflation down. For reference, central banks are supposed to be apolitical, meaning they're not supposed to comment on things like government spending. The fact that the BIS is bashing governments for spending too much is therefore significant, as it could be a way of central banks getting the message out there by proxy. The BIS actually goes one step further, as it outright calls on governments to engage in, quote, structural reform efforts. The authors specify that these reforms should focus on a better distribution of income. Put differently, the BIS wants governments to take from the rich and give money to the poor. In theory, this would solve the problem, but in practice, the rich will find loopholes to avoid paying their fair share. Some would argue that the best solution would be to allow wages to rise and accept the inflation that will come as a part of that process. This would actually improve income distribution. But that would also hurt the bottom line of the globalist corporations, which is why they've been trying to keep wages suppressed through automation and migration. But, well, that's a topic for another time. Anyways, the authors go on to give a recap of what's been happening in the global economy over the last year. They note that the economy has been surprisingly strong and remind the reader that inflation has come down while unemployment has stayed low, though it goes without saying that this could be changing. Notably, the authors underscore the fact that a big part of why rising interest rates haven't done much damage to the economy is because of the duration of the debt. Put simply, most individuals and institutions borrow money at a fixed interest rate for a long term. Short-term changes have no effect. Not only that, but individuals and institutions with lots of cash lying around have been able to earn large interest rates on their savings. This has paradoxically resulted in a sort of stimulus for the rich, which has further increased wealth inequality, but has made headline economic figures look good at first glance. Upon closer inspection, though, the average person is falling behind due to a combination of persistent inflation and higher interest rates, particularly in the UK and the EU. The authors admit that rising energy prices are to blame, but fail to note that these are the result of arguably counterproductive sanctions. Newsflash: sanctions raise energy prices, and rising energy prices benefit the likes of Russia. The result is that Russia's economy is growing faster than all developed economies. This is according to the IMF, by the way. Anyhow, the authors claim that inflation continues to come down and confirm that this is mainly due to a decline in commodity prices. What's cool is that the authors actually provide a detailed breakdown of what exactly is causing inflation to decline. Demand and inflation expectations are also playing a role. What's even cooler is that the authors do a deep dive into the fact that this disinflation is partially coming from China. The TLDR is that China's own economy is struggling, so it's trying to export as much as possible to give it a boost. The result is that it's causing the prices of many goods to fall sharply. However, it seems that most foreigners aren't buying these goods, even at discounted prices. This is fascinating, as it suggests the global economy is very weak. The tariffs placed on Chinese EVs by Western countries also show they're not truly serious about going green, but, well, that's also a topic for another time. Anyhow, the report's authors then provide a long list of indicators which show that investors continue to be in a risk-on mode. These include everything from stock markets hitting new all-time highs to corporate spreads being near all-time lows. Yields on lower-quality corporate debt rise during risk-off events. To their credit, the authors also provide a deep dive into how central banks contributed to the surge in inflation after the pandemic. The TLDR there is that central banks waited one whole year to raise interest rates to combat this inflation, which allowed it to go higher than it otherwise would have. It's almost as if the central banks wanted this inflation to occur. I mean, it's not like inflation is one way for governments and corporations to devalue their debts, right? Say, did you know that BlackRock published a report a few months prior to the pandemic saying that there needed to be more inflation? More about that in the description. I digress. Now, the authors conclude this part of the report with a lengthy analysis of the possible problems that the global economy could face and the scenarios that could occur. The first problem is one we discussed earlier, and that is inflation. You'll recall it could rise again because of goods, wages, or commodities. The second problem is also one we discussed earlier, and that's the levels of government debt and how they've made things tricky for fiscal and monetary policy. In short, fiscal and monetary stimulus will cause debt to increase, while fiscal and monetary policy restrictions will make it hard to pay the debt back. What's eye-opening is that the authors note that it takes 2 to 3 years for the effects of the first rate hike to be felt in the financial markets. Now, the reason I say it's eye-opening is it's believed that it takes between 1 and 2 years, with Fed Chairman Jerome Powell once saying that the effects were instant due to investors pricing everything in. From the BIS's perspective, this means that the rate hiking cycle is still in its early stages and that we're going to feel the real lag effect over the next year unless central banks start cutting now. You'll recall that many already have, and it's possible that this is precisely because of the BIS's own recommendations. What's spooky is that the authors suggest it could already be too late, as China's slowing economy could drag the rest of the world down with it. This ties into the third problem the BIS thinks the global economy could face, and that's excessive government spending to keep things rosy during a big election year. You'll recall that this could cause a resurgence in inflation and would also increase existing debt loads. And this relates to the fourth problem, and that's a decline in productivity, which we also touched on earlier. As a not-so-fun fact, GDP per capita is declining in many Western countries, particularly Canada. Given these risks, the BIS sees 2 possible scenarios that could drag down the global economy. The first is a resurgence in inflation, and the second is a hard landing, aka a recession. And as another not-so-fun fact, a spike in commodity prices has historically been followed by a recession. This means we could get both. Now, the second part of the report is about monetary policy again, but this time the focus is on the future rather than the past. Funnily enough, the authors start by recounting how the 21st century has so far featured a series of unfortunate events, including the 2008 financial crisis and the 2020 pandemic. They note that the pandemic effectively marked the bottom for the decline in interest rates that began after 2008 and could have marked the top for the size of central bank balance sheets. For those unaware, central banks will buy government debt to stimulate the economy during times of crisis. Newsflash, this is what the so-called money printing actually entails. Now, the fact that interest rates seem to have bottomed out during the pandemic suggests that they could be starting a long-term uptrend. This possibility can be seen on the long-term chart of the federal funds rate. It reveals that interest rates fell from the 1980s to the 2020s and now seem to be rising again. As a fun fact, when interest rates began their last uptrend in the 1950s, European stocks were all the rage. In the 1960s, it was American stocks, and in the 1970s, it was commodities. In the 1980s, it was Japanese stocks. In the 1990s, it was American stocks again, and then in the 2000s, it was commodities. Right now, we're in the foreign stocks phase. Can you guess what comes next? That's right, commodities again. In any case, the authors explain that central banks have learned 5 things over the last 2 decades. First, they learned that responding to inflation quickly by raising rates aggressively can bring it down. Second, they've learned that they can print money to prevent the economy from collapsing. And this pertains to the third thing they've learned, which is that there are limits to how effective money printing is in stimulating the economy. Some of you might have heard that for stimulus to increase economic growth, each round needs to be bigger than the last. The BIS confirms this is real. And the report's authors reveal that this effect is most pronounced when there isn't any economic stress. They point to the negative interest rates in Europe and elsewhere as proof. All this stimulus did was inflate asset prices. It didn't stimulate the economy. Some would say that's by design. More importantly, artificially low interest rates result in capital misallocation, something acknowledged by the authors. As we've mentioned in many videos, investment ideologies like ESG wouldn't be possible in a regular interest rate environment because they're just not profitable, sustainable, or even logical. Unfortunately, many powerful individuals and institutions continue to double down on them despite this reality. Regardless, the fourth thing central banks have learned is that, quote, communication has become more complicated. In practical terms, central banks have become more involved in the everyday life of the average person. Once upon a time, this wasn't the case. There was no fanfare around FOMC press conferences, for example. The practical effect of central banks taking centre stage is that everyone has been hanging on every word they say and increasingly scrutinising their actions or inaction. This is making the central banks more political, and that increases the risk that they could once again become another arm of government. As another fun fact, the BIS has warned in its research papers that if central banks become too politicised, then this would result in hyperinflation, as the average person would vote for the central bank to print money to give to them. Who could blame them, though? The rich have been doing it for decades. More about the Cantillon effect in the description. Moving on. Now, the fifth thing that central banks have learned is that Forex intervention can enhance financial stability. As I hinted earlier, Forex intervention involves one central bank printing its currency and swapping it for another currency with another central bank, typically the US with the dollar for another currency. The reason why this is done is so that the foreign central bank can use the USD to buy up its own currency and stabilize it. The most notable example of this has been the Bank of Japan, which has been buying yen with USD to prevent the yen from completely collapsing. It's assumed the swap will never be paid back. Now, what's interesting is that this gives the largest central bank, in this case the Federal Reserve, an incredible amount of geopolitical power. For example, if the Chinese yuan is collapsing and the PBOC asks for a dollar swap, the Fed could reject the request, forcing the yuan to devalue, at least in theory. In practice, however, this would never happen because if the Fed rejected the swap request, then the PBOC would start selling US government debt, aka US bonds, for US dollars. Since bond prices are inversely correlated to yields, this would cause US bond yields to rise, which would in turn cause rates to spike. This should make it easy to understand why forex swaps help with financial stability. They reduce the need for central banks to sell their holdings of foreign bonds to support their currencies. This in turn reduces the risk that global bond yields and interest rates will rise, reducing market volatility. Now, the authors conclude this part of the report with a lengthy analysis of possible challenges that central banks could face in the coming years and the scenarios that could occur. The biggest risk seems to be that interest rates will stay higher than economic growth, as that could drag everything down. The reason this is a problem is because central banks need to keep interest rates high to fight inflation. This means that the only solution is for growth to consistently be higher than interest rates. Logically, this requires a gradual increase in productivity, which you'll recall is declining in most developed countries. The authors touch on the headwinds caused by deglobalization and demographics without noting that the reason why demographics are so bad is because globalization has robbed the average person of their wealth and upward mobility. Fortunately, an increasing number of countries are trying to deglobalize. Whatever the cause, the authors call on central banks to exercise, quote, realism, which is code for please try and keep things low-key and don't rock the boat with big monetary policy changes. At the same time, they call on central banks to be on the safe side and get ready to act when necessary. And finally, the authors call on governments to cut it out with the excessive spending and make the bold claim that constant money printing by governments and central banks may not be necessary to drive economic growth. Once upon a time, this wasn't necessary anyway. People worked hard and lived well. We can only hope that the world will be like that again within our lifetimes. Now, the third part of the report comes out of left field as it's all about artificial intelligence. You know the hype is real when the central bank for central banks is talking about it. In all seriousness, AI could change the world like the internet did. From the BIS's perspective, it could affect central banks, hence the dedicated AI section in this report. Naturally, what comes to mind when you think of AI is a large language model like GPT, the technology behind ChatGPT. To their credit, the authors make this distinction right off the bat. They note that LLMs are becoming increasingly advanced, allowing for the generation of video, audio, images, and text. Again, to their credit, the authors also note that this has led to a debate about whether it's really appropriate to refer to these LLMs as AI, or rather as Artificial General Intelligence or AGI. As far as the authors are concerned, though, it doesn't matter. What does matter is what these tools can do and how they can affect things. When it comes to central banks, the authors note AI will, quote, affect financial systems as well as productivity, consumption, investment and labour markets, which have direct effects on price and financial stability. They also believe AI will affect all banks, especially if they're using AI. The authors reveal that central banks plan to use AI as part of their operations, which is a bit terrifying when you consider that most AI is literally programmed to lie so that it doesn't offend anyone or go against the status quo. It won't be long before AI convinces every central banker to print us all off the planet. Jokes aside, the authors note that even if central banks don't end up using AI, they need to be, quote, observers of the technology and how it could affect their mandates. Spoiler alert, central banks are terrified that AI could cause too much deflation, as that would cause the global debt bubble to burst. This pertains to where AI came from and how it works. The authors explain this in detail, but we'll just direct you to our video about OpenAI and ChatGPT in the description for the sake of time. That said, though, there is one part of the author's explanation worth summarizing. In fact, it's worth quoting. So, quote, LLMs suffer from the hallucination problem. They can present a factually incorrect answer as if it were correct, and even invent secondary sources to back up their fake claims. Unfortunately, hallucinations are a feature rather than a bug in these models. LLMs hallucinate because they are trained to predict the statistically plausible word based on some input, but they cannot distinguish what is linguistically probable from what is factually correct. That, ladies and gentlemen, is a quote to remember. Now, the authors then go on to explain how AI could affect the financial system. They discuss everything from lowering costs to optimizing payments. This is a bit scary as they suggest that AI could be used in, quote, high-risk, low-margin activities like interbank transfers and KYC and/or AML. What could possibly go wrong? Another scary bit is noted in the image here, and that's using AI to assess whether you're creditworthy, i.e., if you can get a loan. When you combine this with the evident biases of AI, you end up with a very scary scenario indeed, one where people who act or think in the wrong way don't get a loan. I'm not exaggerating either. The authors expand on using AI to assess creditworthiness and note that associated checks, quote, can also be of a non-financial nature, for example, applicants' educational history or online shopping habits. And if that wasn't bad enough, they say it can be used for insurance too. For what it's worth, the authors spend even more time addressing the very real bias and discrimination risks that such AI tools would have. They also point to the fact that these AI tools would collect a lot of sensitive data and that most of them would likely be developed by a handful of big tech companies. On that note, the authors believe that AI being controlled by a handful of entities is inevitable. This is because of so-called data gravity, which is when, quote, companies that have an edge in collecting, storing, and analyzing data can provide better trained AI tools whose use creates ever more data over time. The consequence of data gravity is that only a few companies provide cutting-edge LLMs. The authors then look at how AI could be leveraged by the central banks themselves. They note that AI could be used to help collect and analyze data related to their mandates. They reveal that the BIS is already working on something called Project Aurora, which analyzes transactions for money laundering. But wait, there's more. The authors note that there's another BIS project called Project Agora, which involves tokenizing assets on blockchains owned and operated by central banks. When you combine Project Agora with Project Aurora, you get an AI-driven financial dystopia. You will own nothing. The AI will own it all instead. In this case, I'm exaggerating somewhat, but it's honestly not far off from what they describe. And once everything is centrally surveilled and controlled, the authors say it will be possible for central banks to do, quote, nowcasting, which is to adjust their monetary policies in real time in response to real-time changes. If CBDCs launch, then this nowcasting will look more like manhandling. Total control, in other words. At least the authors are kind enough to share all the other dystopian projects the BIS is working on. Highlights include Project Gaia, which enforces ESG, Project Symbiosis, which tracks your environmental effects, and Project Ellipsis, which keeps track of who the central bank needs to keep track of. Yikes. Now, the authors conclude this part of the report with a lengthy analysis of how AI could impact the economy and how central banks should prepare. They start by predicting that AI will help boost global productivity, which you'll recall is required for central banks to keep interest rates high. In contrast to every other AI prophet, the BIS believes that AI will increase the demand for labour, not decrease it. That's because it will make it possible for more people to be productive, regardless of their skill level. Some of you may know that current research suggests that AI helps junior employees the most. The trade-off is that AI could result in increased economic inequality if it continues to be controlled by a handful of big tech companies owned by an even smaller handful of tech bros and asset managers. Thankfully, crypto projects are working as quickly as they can to decentralize AI so that we can all profit. Even so, the authors note there's a real risk that governments will have to turn the money printer back on to support the average person if AI starts to take their jobs. From our perspective, this is unlikely so long as AI is programmed to appease people's emotions and parrot government propaganda. Regarding how central banks should prepare, the authors advise them to focus on developing in-house AI tools rather than leveraging third-party products. This means that central banks will have to hire a lot more tech people. Well, to that we say, good luck competing with big tech companies and crypto projects. Case in point, the authors even provide a graph proving that central banks have had a hard time hiring and retaining their more tech-savvy employees. So, to any central bankers watching or listening, maybe you should start paying them more of that printed money and stop telling them to build dystopian tech that nobody wants. Just a thought. This now brings me to the big question, and that's what all this means for you and for the markets. Well, let's start with the markets. Besides the AI section suggesting the local top is in for AI, the key takeaway from the BIS's report is that debt and inflation are very real risks, and both could create serious market volatility. In the case of debt, too much debt could cause long-term interest rates to rise as the supply of bonds increases too much relative to the demand, causing bond prices to fall and yields to rise. Uncertainty around fiscal policy could also create bond market volatility, which is a bigger problem than you think. You see, government bonds are considered to be the safest financial assets. The result is that they're often used as collateral for loans. Yes, that's right, debt being used as collateral for yet more debt. Government bonds are assumed to be safe because governments can always tax their citizens in order to pay their creditors. But if the value of these government bonds suddenly experiences volatility because of, say, bad fiscal policy from an extreme right-wing or extreme left-wing government, then those who borrowed against these bonds risk being liquidated, i.e. forced to sell. This can result in forced selling across the board. Similarly, in the case of too much inflation, holders of government bonds will demand a yield to compensate for the fact that when the bond is paid back, the money won't be worth what it was when they lent it out because of inflation. This can likewise cause rates to rise and could cause bond volatility. Now, aside from economic growth driven by a parabolic increase in productivity, the only solution to this problem is what macro analysts call debt monetization and what we call money printing. Central banks will have to buy up the excess government debt to ensure that yields stay down and markets stay calm. This will be rocket fuel for risk assets, as they are the most sensitive to liquidity. And at the tip of that space shuttle, you've got crypto. According to macro analyst Michael Howell, BTC prices lag changes in liquidity by 6 to 8 weeks. As we've seen with our own eyes, BTC will respond instantly to emergency intervention, bank bailouts, that kind of stuff. Now, when it comes to what all of this means for you, it's a bit of a double-edged sword. On one edge, interest rates and inflation are likely to remain elevated for the average person for now. On the other edge, meanwhile, this will create extreme social pressures that result in political change, hopefully for the better. As we discussed in that aforementioned video about the end of globalization, most countries appear to be shifting towards a form of economic nationalism. In the short term, this will suck because asset prices will stay high, while the prices of goods rise as a result of workers finally being paid their fair share. In the longer term, however, asset prices will cool off and wages will continue rising. This means that in the next decade, buying a house and starting a family will become much more affordable. Most importantly, how hard you work will finally be reflected in your paycheck, which will supercharge economic productivity. In economic terms, the power will shift from capital to labour, and this will set the stage for the commodity market cycle in the 2030s I alluded to earlier. For the rest of this decade, though, it will probably be more of what we've seen in recent years, increasing political and geopolitical instability. Asset prices will probably keep rising because of central bank money printing, and I'll remind you that crypto will be the biggest beneficiary of this liquidity increase. As we approach the end of the decade, though, it may finally be time to take some much-needed profits as hyper-financialization starts to fade. I know it's a cliche, but this is a real turning point. We are at the peak of globalization, the peak of wealth concentration, the peak of financialization, the peak of geopolitical and political instability, etc. What comes next will be a new generational cycle of genuine growth, prosperity, and equality. So, Make it count. And that's all for today's video. So if you found it informative, smash that like button to let us know. If you want to stay informed, subscribe to the channel and ping that notification bell. If you want to help inform others about what's really going on in the global economy, then share this video with them. As always, thank you so much for watching, and I will see you next time. This is Guy, signing off.